Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in there, take a look, see what people are sharing, and I'll share my opinions as we go through it. If you want to follow me at _finance, and if you want to join our community, finding-value.com. I dive deeper into all of these topics and subjects, looking for potential investment opportunities. So we've got a coupon code. Special is the coupon code. That is the discount coupon code that you type in for 50% off the first month only on the monthly membership, and a larger discount on the yearly membership if you'd like to try it out. We also have a question and answer session today at 5 p.m. Mountain Time on a Zoom call on the website where you click in, you get in there, and you can view that and interact with me directly. So Shay, he posts, here are the top 15 growth performers so far in 2025. And we've got these gigantic movers moving in 2025. Oklo being the largest performer, at least on this list here, of these guys. And I was just looking at Oklo. I said, you know what? Let me pull it up. I know this is a small modular reactor company producing. Look at the move that it's had from late 24 all the way up. Probably has something to do with, I think, this is Bescent, I think, and he's on the, or no, it's Liberty Energy. I think the energy secretary. I think that's who it is, and he's on the board of Oklo. I think that's who it is. But I was just looking at it, right? You know, this is the biggest performer. Should we chase performance? Should we chase this thing? I just looked at the financials and I went to statistics. They've got huge dilution between quarter one and quarter two. I don't know the reasoning behind it. 30 million shares to 122 million shares. They have a very high price to earnings ratio. Their price to book is 22.15. They make absolutely no earnings. They are all negative, and they've got a cash flow that is negative. Their income and total revenue is zero. So this company doesn't make any money. They've recently diluted shares, and you're paying through the nose on a price to book ratio of over 22 on a price to book, which means you're paying over 22 times the assets that they've got on their books. So would I go into this? No. This is something I would not go into. And some people are going to say, well, it's gone up all of this amount. It's up huge. And that very well is the case. But a lot of these companies that possess this type of move, I may or may not be in these types of moves. This is just money flows. It's speculation. It is people getting psyched up on who's on the board and who's getting elected. I don't play those types of moves. Now, I'm going to show you a company that is done incredible things. This is AutoZone. So AutoZone is a company that has done incredibly well. Now, this is something that I get attracted to. Not saying that I'm buying AutoZone, but I like what they've done with the company. This is logarithmic. Look at this thing go here. Look at that thing go. This is probably the most beautiful chart I've ever seen. It's gone from in 1990 from $7 all the way to $3,420 a share. Look how easy the ride this is. No big pullbacks, up, 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 up. How did they do that? What's the special ingredient sauce that AutoZone has? I'm not looking for a short-term spike. I'm looking for this. I want a powerhouse company that delivers returns to shareholders year after year after year. And that's, I think eventually, perhaps small modular reactors will do that out in the future. But you don't have to speculate on something that has zero income. You can find companies that have income. Now, if you look at some of the financials here, and I'm not stating that this is going to be cheap by any means, and I'm not stating that this is a good buy even, but they've got earnings, and their earnings As you look at their earnings, they started out at $40 in earning in 2016, up, 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 up. Their earnings just continue to grow rapidly, and their forecasted earnings out in the future is a powerhouse. If you look at their earnings per share or their share count's been declining. What have they been doing? They've been buying back their shares. That is something that is good. We've got the price to earnings ratio that fluctuates. It looks like it's fluctuating around about 15, 16 over time. You can see some years are over that and some years are under that. Like this is 12 in 2017. Uh, at probably a good spot to maybe look. And if you look at 2017, that was in this area here. That little dip that occurred is 2017. That's a good time to accumulate as it continues to go up, as earnings continue to do well. So this is a company that I look for. Now looking at some of the financials, look at some of the balance sheets and what this company is doing. You can find companies that have um, similar deployment of capital, similar return on capital, similar share buybacks and all that stuff in commodities. In commodities, when you buy something at a low, I'm looking at this for a potential return eventually. That's what I want. I'm not necessarily looking at these companies that go up a lot in a short period of time, but are completely mispriced in terms of their financials. So if you're looking for something like you want to buy value in the market, and you're looking for companies that may possess something that looks like this, that's what I'm going after on the website. The companies that are undervalued that can provide returns for a decade plus in this commodity bull market that we have just basically started to turn into. 2020 being the bottom, and we're seeing huge patterns too, bottoming patterns in commodities. So just sharing kind of the difference that people are posting. People are chasing returns here, and I don't think it's going to end well for them given the financial metrics and the prices that you are paying. Because platinum versus gold, one is likely to outperform the other. Historically, platinum trades at a premium to the price of gold. Today's gold price is 28.87. With platinum currently trading just over $1,000 and gold near 3,000, the ratio is at an extreme not seen in our lifetimes. I'm long-term bullish on both metals, but the risk-reward ratio for platinum is far more favorable at current levels. I agree with what he's saying. This is completely favorable for platinum. It may not turn immediately. Platinum will turn when the change, which they're changing right now. We'll see platinum and oil and copper, all of those things I think will perform. Platinum runs more with the commodity group than it does with the precious metals group. Gold front runs it. So gold's been front running kind of everything. Um, it's front running oil. It's front running some of these other commodities, and that's going to eventually flow into platinum, oil when it makes its way into the system, that liquidity. So gold generally runs first, and there's a 12 to 18-month lag by the time it gets through and runs through all these commodities. And I think we're getting closer and closer to that time. I don't know the exact moment, but I think we're getting real close here in 2025 for all these breakouts. This is a quote by Jesse Livermore. Jesse Livermore is considered to be the most successful trader. I'm a hybrid. I used to trade, and I don't trade anymore because I don't think you make as much money. It's a lot more stressful, and I don't. It's. I'll just say it doesn't make as much sense to me as fundamentally investing. But some of the quotes he has does apply to both a hybrid investor and a trader. So this is one. It's just a quote that I grabbed. It says, "The average man doesn't wish to be told that it is a bull or bear market. What he desires is to be told specifically which particular stock to buy or sell. He wants to get something for nothing. He does not wish to work. He doesn't even wish to have to think. He just wants to be told what to do. So a lot of people, they're looking around, they just want stock tips. That's all they want. Coming to this next one. This one I think is incredibly important. It says, I think it was a long step forward in my trading education when I realized at last that when old Mr. Partridge kept on telling other customers, well, this is a bull market. He really meant to tell them that the big money was not in the individual fluctuations, but in the main movements, that is, not in reading the tape, but in sizing up the entire market and its trend. And that's exactly what I've done. I've sized up the trend and when these trends occur. Now, that doesn't mean that you will get rich quick. Jesse Livermore was a trader. He went bankrupt 3 times and made ridiculous sums of money in somewhat short periods of time. I'm not trying to go bankrupt. What I'm trying to do is build wealth over long periods of time and massively compound it. Jesse Livermore was more of a gambler, and most traders are. I'm not set up that way. I don't want to lose and go bankrupt. So what I do is I allocate a little bit different. I'm a little bit more conservative, and I go after value. And then that value, if you can size the markup and the trend, size the entire market and get the trend right. Let's say it's for a commodity bull market, and I choose undervalued commodity companies that have the traits that incredible companies possess, and I look at what they're doing with their cash. I can have incredible returns and probably beat the majority of these best investors if I am patient enough. I am adopting all of these guys, um, I'll say it, all their words of wisdom, trying to at least, and apply it to the markets using the 3 pillars: technical analysis, ratios, um, and technical analysis, ratios, and market conditions. Market conditions tell you basically sizing up the entire trend. Ratios tell you when something is cheap or expensive. And if the trends are changing, we should be seeing those ratios change. The market conditions and the ratios are a function of each other. And then technical analysis is the way that I evaluate it all. So, like for instance, this is a ratio chart. Gold versus SPX ratio, and this is just a long term. It's expensive back here. It is cheap down here. And we're also cheap right where we're currently at. What causes this ratio to go up and down? Well, this ratio went from a peak here all the way to a bottom because interest rates were coming down this entire time. They bottomed in 2020. So this entire movement here, it had a huge tailwind from interest rates. And this ratio got cheaper and cheaper and cheaper. We were also at an overvalued state where gold was expensive. So it's a combination of the market condition forcing the ratio to an expensive state, and then that market condition changing, and then the ratio going all the way back down. This would have been your most favorable long-term trade where you're sizing the entire market up correctly from 1980, 81, 82, where stocks bottomed, and you rode it all the way to 2000. This here, what you would have done if you could do this, and you knew basically where you were located in 1980s, you'd want to ride stocks the entire time. And then in 2000, 1999, 2000, it bottomed, and you wanted to be in gold. And we had a pullback here. It's not as far back, and I think we're going to have another breakout, which I'll show you when we zoom in here, where gold's going to outperform the S&P 500. So you don't want to be. It's not about an allocation. I want an allocation of gold and S&P. It's what do I overweight and where should I be? Gold from 2000 onward is where we should be. S&P 500 from 1982 all the way to 2000 is where you want it to be. If we kind of zoom in on that, there's your downtrend line break to the upside where gold's going to start to outperform the S&P 500. And when gold outperforms the S&P, that's when commodities do well. You're sizing the entire market trend. That's how I'm doing it. And then you come in, this is your commodities to equity ratio, and that's bottomed and starting to come on up. It's sizing the entire trend correctly. What is causing these market movements? So what causes this market movement is just money flows, money coming into commodities, money flowing out of commodities, money coming back in, coming back out, coming back in, coming back out. And for the most part, interest rates is a big driver of that. Interest rates and credit creation. Credit creation drives interest rates up. Credit creation is money supply growth. And money coming into the system is inflationary. Inflation drives interest rates up, and then you see money rotating back and forth. And this is what I teach on the website. It's all this. Now, this doesn't mean that you'll get rich quick. We've been down here. This was down in the 60s. If you had ridden just one of these up, even if you were a couple years early and you were waiting and bottom picking all of the best companies, you would have made so much money. It's ridiculous. If you were in gold and silver mining companies, huge move. If you were in oil companies during this time frame, huge move. I think this move here is going to be very similar to the move that's coming. It's going to be similar market conditions, increasing interest rate environment, going up. Money's going to rotate out of bonds, which it already is. It's going to rotate out of stocks eventually when interest rates get to a certain level. Then the money's going to seek safety and yield somewhere else. So that safety and yield is going to be in precious metals, and it's also going to be in energy, because I think energy is going to be the driver of it. Credit creation and energy tightness, specifically oil. Kevin Carpenter, he posts Charlie Munger quote, "You've got to remember that in our way of thinking, all intelligent investment is value investment. Why would you want to buy something that wasn't worth as much as you were paying for it? All good investing is value investing by definition." So let's just apply it to Oklo that we looked at. Now, Oklo's been going up. People are going to say, well, it's up 100 something percent in 2025. Correct. But is it of good value? No, it's not. So what does someone do? Do they go buy it? Do they speculate in it? I wouldn't. I think he's right. I think it's smart to buy something when you're paying a lot less for it than it is when you're paying 20 times book. So I don't know. I mean, that's just kind of what I've been migrating to, is the value investing side for sure. Eric Yoon says this guy gets it. The COMEX was basically a price-setting paper exchange, never intended to be a large physical delivery market. The question I have is, why do we have markets that are just paper price exchanging? Why wouldn't it be a physical delivery market? And if it's not meant to be a physical delivery market, why do we even have it? Now, obviously, that's going to be obvious to everyone who's listening. They're going to probably be yelling into the screen because they're manipulating the price. That's probably the main reason why COMEX was created. Dear son, you're a man. Stop being an introvert. Strangers will make you rich. Start networking, dear son. I kind of have to disagree. You can't stop being an introvert. You're either an introvert or you're an extrovert. I'm an introvert. I recharge when I'm not around people. I think extroverts are highly annoying most of the time. Not all of them, but a lot of them are. A lot of them, what they do is when they're trying to solve a problem, they speak out loud. It's annoying as heck because you hear so many stupid things. Um, it's not about stopping being who you are. Continue to be an introvert. What it is you need to get out of your comfort zone for some of the time and start networking, which I agree with. And you need to start getting yourself out there. But that doesn't mean you stop being who you are. Being an introvert is not a bad thing. Smart Reese, I just thought this was funny. He says the fact that most people who understand housing block or mute him might have something to do with it also. And this is Darth Powell. I sure don't get a lot of people telling me how wrong I am about the housing anymore. Weird. I blocked him or muted him. I can't remember what I did. But he has the most annoying crap, and he keeps calling for a housing market crash ever since I went on to X. So I think I muted him. I hardly ever block anybody or mute anybody on Twitter. There are a few people I do have blocked or muted, but it's usually people who continue to message me, and put. They always like flag me for everything. It's like, okay, guys, I don't need to see all this stuff. Like, that's enough. And I didn't mute him because I disagree with him. I mute him because he's wrong. That's why I muted him, and it's really annoying. So what he said is completely true. He says the fact that most people who understand housing block or mute him might have something to do with it also, because he doesn't understand the housing market. Not saying that I am 100% in the know, but he doesn't. Warren Buffett says the business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective. I see this a lot when I used to work. There's all these people. They would look at these guys or girls, whoever, they'd have this solution, and I'm just sitting back. I'm like, this doesn't make any sense to me. This person's like, oh, we'll fix it with this fixture, and I'm like, okay, you're gonna create a fixture to save us like 2 minutes of time, but our total manufacturing lead time is like 6 weeks, and you're going to save a couple of minutes. And I'm not anti saving the couple of minutes, but I'm like, that doesn't do anything. It doesn't move the needle. It's nothing. And then I will have like this simple solution of how to shave out like 2 weeks worth or a week worth of manufacturing lead time. And they look at this guy who created a complex tool that saves 2 minutes, and they're like, this is the best thing ever. We need to give this guy some like huge increase of merit increase or whatever. Like they link it to something. And I sucked out, a week or two of lead time based off of the things that were super easy to take out of the system. Maybe it's the signals that people are getting. It's sitting on certain areas. I just and I would get rewarded, and it would be like, really, that guy saved 2 minutes, I saved 2 weeks, and that's the same type of response. I don't know. I just find it really really weird. So there's complex solutions or behavior, and then there's simple solutions or simple behaviors that you can do that are far more effective. I just hit whatever was the most effective all the time, and I made it look way easy. And I don't know. I just it seemed obvious to me, but whatever. Also, a lot of my solutions didn't require any money or anything. The complex ones did. Oil to gold ratio, gold to oil ratio. So I look at these ratios. This is what I see as cheap. So cheap oil's down here. Now, some people say this isn't a tradable thing. This guy's a big trader. You're going to chase this value trap into poverty soon. Oh my goodness. What? I just got to shake my head. Everything is turning into favor for um, precious metals breaking out against stocks, precious metals breaking in all currencies. Commodities follow precious metals with the time lag. Do they even know that? Are they sizing the big trend up? Have they made any money in their life before? Most of these people have not. Have they gone broke? Have they gone bankrupt? Have they lost a lot of their money? That's trading. I haven't. So I continue to just pile forward. And I've developed the strategies to do that. Now, to me, this is a falling wedge, breakout, falling wedge, and we're about to break out. This is something I'd be watching. Here it is, it's zoomed in. We're right in the corner here, we're trying to break. We're going to eventually break out of here. So, crude oil, I think, will be the driver of many problems in the future. And what I think is a possibility is that I want to be invested in what the future has, and something where I won't get blown out. I want it to last for many, many years. So I think oil is going to be a good spot. I think natural gas will be a good spot. I think investing in nuclear power is going to be a very good spot. It's all energy related, and you can use energy for a variety of things. I don't care what company is the is the best semiconductor builder. I don't care what company develops the best AI. I don't care what company develops the best robots. All I care about is that energy consumption goes up. And if AI is as successful as they claim, what that means is that energy consumption and commodity consumption will go up exponentially. So I'm investing in energy for the long term, and I'm looking at companies that possess the traits that great companies have. And then I invest in them for the next 10, 20, 30 years. Because I do think that 2020 was the ultimate bottom in a lot of these commodities and energy companies. And I think we're going to see a big move, a very big move, because of money rotation, increasing interest rates, and all that stuff. Now, could artificial intelligence and robots shift the increase of interest rates to a declining interest rate, and that we would see a decline in the cost of products and goods? Very well could. It very well could, but I still think that energy demand is going to go up and up and up. So my investing is off of artificial intelligence. It is off of value. It is off of money creation and interest rates going up and all of these things that we're seeing in the market. It's a full alignment in energy. Precious metals too. It's a function of interest rates and um, energy shortness. I'll call it energy supply shortages potentially, and the squeeze that we would get. This is gold versus crude oil, just done differently. We're getting up there. If we zoom on the right-hand side, I extended this outward. We broke through that uptrend, and we were coming up doing a retest, and we'll see how high this goes. Even if we break back up above this, it's still going to come back down because you're at a ratio that's so cheap. Oil versus the S&P 500. I like looking at all these. Oil versus S&P is way down there. It's super cheap. We started in 1999. Remember that commodity to stock ratio I showed you? This was also a bottom, and then we went all the way back up here to 2008. I think this is going to be a double bottom, and we'll come all the way back up and break and move on up. But that's me. Maybe I'm wrong. But I think crude oil in the short term is going to go up for a period of time, and we'll see how sustaining that is. That's zoomed in on that right-hand little spot here. I zoomed in on it. We squeezed up, broke out, doing a retest, coming back, and it's got a bullish engulfing, which could signal a potential bottom here for crude oil versus the S&P 500. This is oil versus the NASDAQ index. So these are the market conditions. NASDAQ bull. Remember that 1980, 82, 83 top in that ratio? We looked at the top. That was the peak. Then we came all the way down to 1999. If you had loaded in 1999 oil and just held it for a 10-year period roughly to 2008, you made bazongas money. Then we went into a bear market, and we've ended the bear market in 2020, and we're in a bull market now for oil in relationship to the NASDAQ. Even though the NASDAQ went up recently, the most recent NASDAQ movement brought us downward this way. We've broken out of that pattern. We've come back, and we've got another kind of bullish setup here on a return backtest, retest move. Smart real estate bets. The degree to which people confidently post crap that is dead wrong. The young adult population is not falling. It's in the midst of a record 30-year surge. That's why household growth has been at all-time highs. Is it hard to figure out newborn babies don't get jobs and form households? Yes, they are complete morons. I don't understand the people who share a lot of this data in the real estate areas. They are morons. Hate to say it. They have no idea what they're doing. Darth Powell, Reventure Consulting, all these people. This is the actual data. Prospective new home buyer demand from 65 to 2042. What we're looking at are people. So this chart reflects the U.S. birth rates shifted forward 26 years. And in fact, it's shifted even further than that forward, because if that is the case, your first-time home buyers and family formations are coming in there, and they're going to drive it up. So you have to make sure that you are accounting for the age that people are buying these homes. And that's where it goes up to mid 2030s if you shift it for 26 years. I would have shifted a little bit more. I think we're even earlier in this shift. And obviously, affordability is going to have an impact too to some degree. This is your annual US household growth from 65.3. We're at all time. This is like the greatest amount of new households being formed ever in history. This is a driver of capital rotation. It is a driver of a commodity bull market. It's a driver of many things because as you go through life, you're going to hit in your life certain areas where you have max spending, having families, having kids, buying crap for the kids, traveling all over for the kids, etc., etc., etc. It's where people are at in the stage of their life. Coming on back. Jordan says, I've mentioned gold versus the consumer price index is the best long-term indicator for gold stocks. Makes sense as inflation-adjusted gold price correlates with minor margins. I don't like throwing two charts on one graph, but can't help but notice the strong correlation here. Miners are running below where they should be, but that's because valuations have not caught up, but they will. So we can see how low they are, and you can see gold has been outperforming the consumer price index. Essentially, what we're charting here is the miners' margins. And eventually, the gold stocks will catch up to this, and it'll be a rapid catch up. So that's an opportunity. That's value. That's buying a stream of cash flow in the future for a cheap price. That's what gold stocks are right now. And we should be looking at those opportunities, in my opinion. Next big trade, it says, when I was younger, I was one, looking for trades more, and two, betting more aggressively way more often. Now that I have 20 years of experience, I can vary exposure, go to cash whenever, and not worry about missing anything. The truth is, all you need is a few good trades to make a year. And I'm not a trader, but all you need is a few great companies with huge asymmetry to work out for you. That's all you need. You don't need everything to work out. The goal is to find as many companies as possible that will work out, but they won't all work out. That's part of investing. That's why you have portfolio allocation. That's why you research the companies, and that's why you position size correctly to what you think the company possesses and the traits that it has and the value. Here I correct with red lines, copper versus oil demand. So he thinks oil demand is going to go up, not go down like this to 2040. And then he thinks that copper demand supply is going to go up. Now, here's the thing that I don't understand. I don't think we can get to this amount of copper in 2040. I don't think we'll ever get to that amount. So what impact if copper does what he drew there, or maybe it doesn't even hit that, maybe we go to 2030 and roll over. If we roll over at like 2030, what does that mean for oil demand? What's the impact to the world? Do we need AI to figure out how to transfer electricity and generate, some of these engines and stuff with copper? Do we need something else? Do we have alternatives? Is there alternatives? I don't know. Do we even need cars when we get AI? I have no idea. Is it going to be something completely different? Who knows? Mineko64 says fiat currency is the instrument of the deep state, and a sound money system is like kryptonite to them. The deep state will only be eliminated when their fiat abomination collapses and gold and silver reassert themselves as the base for sound money. I agree. I totally agree with that. They gain all their power from the ability to manipulate the currency system. If you take that away, they are screwed. Every president or politician who keeps them in power is for them. JC Parrott's financials are the market's bodyguards, Steve Chauvin. And if this is going up, the market is looking good. Financials also go up when you see these big commodity bull markets, which are generally driven by the real estate market. Financials do well when they make a lot of loans against real estate, especially against new homes with brand new loans. The median age of buyers increased to a peak of 56 years old, up from 49. The median first-time buyer age increased to 38 years old, increasing from 35, while the typical repeat buyer age also increased to 61 from 58. These are all record highs, and that deals with affordability. You can see here back in history, 07, 08, 09, it dipped down to 30 years old. Now we're back up to 38 because I think the affordability is having a huge impact. The Crude Chronicle says this led to a decade of underperformance for ExxonMobil 10 years ago. Will it repeat with the market darling Microsoft? So you can see peak capital spending occurred in 2013, and that was the peak of the market. Had a horrible next decade after that. Right now, we're at peak capital spending for maybe Microsoft, and we'll see if that has a bad decade ahead of it. I think it will, not because of capital spending, but because of what I think is coming in interest rates and the valuations of things. I think interest rates going up is going to be a real huge headwind for tech stocks and other areas. It says, what's going on with Canada and Australia? The real estate debt bubble in the US in 2007 looks almost cute in this chart. And there's 07 here for US. We've come way back down to 97. That's household debt to disposable income. Canada and Australia are off the roof here. I mean, they're through the roof. Wow. India gold imports way up, way up. Highest level in over a decade. That's looking quite interesting. Tracy says the U.S. is spending more on interest payments than on defense and Medicare. So we basically exceeded that in 2024 for the net interest in the red, going above defense and Medicare out here. Oh, and I've already talked about that one last time. So we're going to end it there, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. We've got that question and answer session coming up later today, 5 p.m. Mountain Time. And we'll catch you guys there. This is Finding Value.